So the economic update for July 2024 from one of our mortgage lenders has just landed in my inbox. So in a second, I'm going to go through that with you. But before I do so, can I please ask you to quickly save this video if you haven't got time to watch it right now, and then you can come back to it later. I'd also like to ask you to like the video or give it a thumbs up if you're watching on YouTube, and to also share the video because we are trying to reach a wider audience who might find this information useful. So it really would be appreciated if you could do that for me. And last but not least, if you're not already following me or subscribed to me on YouTube, then please go to my profile, click on my beacons link, and go and take a look at all my social media profiles because we do produce a lot of content that you might find useful, and the content varies across each different platform. Anyway, let's take a look at that report. So, looking at the overview, the new government inherits an improving economy, but the bank needs to see more progress on inflation before it acts. Given the huge structural challenges ahead in health and housing, it will be a relief for the new Labour government that its economic inheritance is improving. GDP growth in Q1 was revised up to 0.7%, and with inflation back to target, interest rate cuts feel closer, and we have got our fingers crossed that they could come in August, hopefully. Once households feel confident enough to spend again, a solid recovery is in sight. Positive real wage growth is gradually repairing damage done during the cost of living crisis, and the high savings ratio seen in Q1 gives strength to the argument that pent-up demand could lead to GDP growth above our current forecast of 1.1% in 2024 and 1.6% in 2025. Although inflation is back to 2%, the deflation in goods prices that brought it there may not have much further to run. History suggests that annual price rises in services close to 6% is not consistent with inflation remaining at target. The MPC was not quite ready to act in June. A first cut in August is likely if progress is made. And this is the thing that we've been talking about. The sticky services inflation is the thing that's making the Bank of England pause for thought. They don't want to decrease rates too quickly, cause a spike in inflation again, only to then have to go and put the rates back up. So they really are playing it very, very safe and cautiously. Market expectations of where rates will be in the coming years has already nudged down, leading to significant repricing of mortgage rates, which we are seeing an awful lot of at the moment. As I said, another quick reminder here, if you're not following me on all my social media profiles, you might want to go follow me on Instagram because I do post daily stories on there relating to when the mortgage lenders are reducing their rates. And at the moment, we're posting lots of them on a daily basis. We still believe house prices are 10 to 15% overvalued, but a combination of strong income growth, further modest cuts in product rates, and small house price falls would see the market back in balance by the middle of next year. And then if we take a look at the risk outlooks, dangers from keeping interest rates too high for too long remains a key economic risk, albeit one that is starting to fade. Despite a rise in unemployment, the labour market still looks tight. And the measures the new government recognises it needs to take, helping get those detached from the labour market back in and to better match people with jobs, will not happen overnight. The same is true of the housing market reform, but this area is likely to be a big break from the recent past. Geopolitics is one area where risks are now probably more heightened than normal. The US Democrats are in disarray, and most polling shows Donald Trump on course to win November's election. In that event, the US would probably halt support for Ukraine and seek to alter NATO's strategy. Europe will have to devote more resources to defense, something the next French government may look positively on. But for now, markets are in risk-on mode. As the Bank of England's recent financial stability report highlighted, this can quickly change. So let's take a look at the individual sections one by one. And just to say, there is an awful lot of information in this report. So rather than me go through all of the graphs and everything, I will put a link on the YouTube channel for you to be able to go and take a look at this report yourself. And then if you wish to, you can look more in depth at the graphs, etc. The link will only be on the YouTube channel because that is the only place that I can leave it. So again, if you're not following me on YouTube, please do go over there by clicking on my beacons link, hitting YouTube, and then go and subscribe. So, inflation and interest rates. Inflation fell back to 2% in May, a couple of months earlier than expected. Services inflation remains too high for comfort. Despite the good news, markets immediately saw slightly less chance of an August interest rate cut. The MPC is mandated to target headline rate and not to worry about relative price movements, but goods price inflation may not remain negative. Producer prices are edging up. Energy bills will fall significantly in July, and there was finally some good news on food prices in May. Inflation is expected to bob around target in the coming months and end the year slightly higher. The Bank of England still needs further reassurance that underlying pressures have been subdued, and this may come in August when it is in possession of a new set of forecasts. When the dust settled after the decision, markets priced in slightly lower interest rates right along the curve. With competition fierce in a thin market, this has already had a significant impact on mortgage rates. And as I just said a few moments ago, we are seeing lenders on a daily basis announcing rate reduction. And some of those reductions are actually quite big, meaty ones. Moving on to the labour market. Although unemployment rate has risen to 4.4%, it is difficult to make the cause that the labour market is cooling down. Current wage growth is not consistent with a 2% inflation target. Concerns over the quality of headline labour force survey statistics are amplified by less pessimistic trends seen in surveys of employers which estimate job numbers and PAYE records. Unpicking this is a difficult task for the MPC. The numbers we can trust most show redundancies at normal levels and vacancies down, but not quite at 2019 levels. Not many people are losing their jobs, and those looking for employment are finding it harder. The rise in unemployment is slightly at odds with the improvement in economic growth. We do not expect the rate to rise any further, but there are clear risks it will if interest rates remain higher for longer. Moving on to the housing market. Despite more sellers entering the market, according to surveyors, there is no sign yet that headline prices are softening. It is hard to pick a pattern out of the regional numbers. Our forecast does pencil in modest further falls given the disconnect in what affordability measures suggest about the current combination of house prices and mortgage rates. HomeTrack estimates that house prices were 8% overvalued in Q1. Housing policy and taxation has potential to disrupt the market post-election, but big moves like capital gains tax on first homes and revaluation of council tax bans seem to have been ruled out by Labour. Prices have been underpinned through longer mortgage terms and high loan-to-income ratios. The Bank of England returns show the proportion of high LTI approvals fell sharply in Q1, although some industry figures are surprised at this. But these sources of support do not look that sustainable in the long term. And this is talking about when people are coming to remortgage, finding themselves having to go onto higher rates, what they're actually doing is extending the mortgage term to alleviate a little bit of that pain. And of course, in the long term, extending your mortgage term isn't the most sensible thing to do. It may well serve a purpose for a short period of time, but in the long run, it's just going to end up costing you more money. So it's more sensible that when rates start to drop again, that you try to bring your mortgage term back down. Moving on to the rental market. Rents on new lets across the UK are up around 6% on a year ago, but growth in London is just 1.3% after a fall in June. Zoopla also reports drops in Nottingham, Brighton, York and Cambridge over the last quarter. Affordability, as ever, is key. Demand is still outstripping supply across the UK, and rents are expected to end the year 8.2% higher than a year earlier as existing tenants roll onto new contracts. And this is something that we're seeing. With our professional landlord clients, a lot of them are saying that when their rent reviews are coming up, they're actually having to increase rents just in order to be able to actually afford their mortgage payments. And a survey by Foxton suggests that landlords are indifferent about a Labour victory, but abolition of accelerated no-fault evictions feels on the cards, with possible improvements in EPC requirements also quite likely. But the recent rocketing in rent reveals supply as the big challenge. Labour's plans to build 1.5 million homes over the course of the next parliament would ease much of this pressure and potentially boost the buy-to-let sector. But this is much easier said than done. Moving on to mortgage market activity. Activity has improved over recent months, but affordability limits the extent of any upside. Lower rates are needed to unlock the market. The good inflation figures have brought some relief. With firms competing aggressively for market share, again, as economic uncertainty lifts, the market could improve faster than expected. And this is what I've said, because day in, day out, we're seeing lenders reducing rates. We're also now starting to see lenders adjusting their criteria to make mortgages more affordable for more people. So the competition is really starting to warm up in the mortgage market. Borrowers are still betting that mortgage rates have further to fall, judging by the higher proportion of variable rate products taken out in Q1. And while fixed rates are still the preference, most of these are now written on terms of 2 years or less. And if you do watch my other content, I have covered this sort of thing off quite recently. There is a discussion regarding whether or not you should go for a 2-year or a 5-year fixed rate. 2-year rates are more expensive than 5, but of course, if we expect rates to drop, then a lot of people are preferring the 2. There has then been discussion about tracker products, but I personally feel that tracker products are still not a suitable choice. I think that the margin over the base rate on tracker products is still too high when you compare it to the next cheapest 2-year fixed rate. I honestly don't believe that the Bank of England base rate is going to drop quickly enough in order to make a tracker product a more financially viable choice. So therefore, I still believe that 2-year or 5-year fixed rates are the way to go for clients. Vendors are back, but only a small majority of surveyors questioned in May expected that to be translated into improving sales. HomeTrack reports sales up 8% higher than a year ago, but still well below what might be thought as normal. And as I've said, we are starting to see a lot more inquiries, but this is not yet turning into written business because there is this hesitation and this belief that we're going to wait until the Bank of England reduce rates. That's a clear sign that the economy is improving, and we'll wait for mortgage rates to fall a little bit further, and then we'll go ahead and start purchasing these properties that we've been inquiring about for some time. So I do honestly believe that the second half of 2024 is going to be a much more positive. Moving on to mortgage rates. The effective rate on new lending in May was 4.8%, with quoted rates in June on 75% loan to value products in a range from 5.16 for a 2-year fixed to 4.65 for a 5-year fixed. No one can say with any confidence what the neutral interest rate is, but markets are pricing in a rate around about 3.5% for bank base rate. Our view is at the top end of expectations. A fall in inflation below target, not an outlandish view, could see product rates fall further. With firms looking for market share, the proportion of deals with rates less than 2 points above base is high by historic standards, although the bank rate is expected to fall, of course, which is what I was just saying. But overall, the story is one of continued squeeze on margins. So there you go. That's a very quick round of how the economy looks from a mortgage and property perspective. I hope you found it useful. Again, as a reminder, if you're not following me on YouTube, please do go click on my beacons link and hit the YouTube channel and subscribe to me over there. Because if you do like to look at these reports in more depth, then that's where you'll find the link in the video notes so that you can go and take a look at all the graphs and charts and everything else. And then you can analyze the data for yourself. Thank you so much for your support. I really do appreciate it. If you could like, follow, and share the video, that would be amazing. But again, I hope you found this useful. Thanks for watching and take care.